Good afternoon and welcome to today's presentation, Business Valuation, Understanding the Value of Private and Public Companies. In today's webinar, Mr. Swift will discuss understanding asset-based, income-based, and market-based valuations, purposes of valuation, and commonly used methods of valuation. To give you a little background about our presenter, Tim Swift, he has 14 years of valuation experience in corporate M&A in the telecommunications and high-tech industries. He has performed valuations of several privately held businesses for litigation support. Mr. Swift is a member of the National Association of Certified Valuation Analysts. His articles have been published in the #1 academic journal in strategic management and the #1 academic journal in planning and development. Attendees who require a passcode, the word for today is value. During the Q&A session, we will ask that you enter this passcode into the Q&A widget for CLE reporting purposes. The Q&A is located to the left of your screen. Please remember that if you're applying for CLE credit, you must log onto your computer as yourself and stay for the full 60 minutes. You are also required to complete the survey at the end of the program. Tomorrow morning, we will send out an email with a link to the archive recording of the webinar. The slides can be downloaded from the resource list to the left of your screen. Thank you all for attending, and Tim, the presentation is now turned over to you.
Great. Thank you very much, Emily, and welcome to everyone that's on the webinar. I'm sorry to hear that I don't have time to get everybody to introduce themselves. So in the interest of time, let me just get started. I don't know about folks on the phone, but whenever I've gone to a presentation and somebody stands up there and speaks with authority, I've always wondered who they are and why they get to do that. So I am going to take a minute and tell you a little bit about myself, my background, and what brings me here today. Let me see if I can get this picture up here. There we go. That's a picture of my family. I'm the guy on the right, and as you can see, my wife is aging a lot better than I am. I blame my advanced age on the two knuckleheads that are circled in this picture. Bobby's the big guy up top. He's our oldest. He's a freshman at St. Joseph's University in the Philadelphia area. Considers himself pretty good at ice hockey, but I'm not so sure about that. But he's a good kid, thank God. And Jack's the little guy. He's very, very serious about Boy Scouting, and he's almost an Eagle Scout. And he actually is a very good drummer. We have no idea where he got his talent from. And we live in Bucks County, which is right outside the Philadelphia metropolitan area. Let's see. I thought it might be important to let you know that in addition to having a PhD, I'm a professor in Philly. I'll tell you a little bit about that in a second. As Emily mentioned, I do bring corporate experience, which helps me in this valuation work. I spent 14 years at both AT&T Corporation and at Unisys in the Philadelphia area, doing a lot of corporate strategy, and in particular, I was one of the inside guys on a lot of our mergers and acquisitions work. There's some really complex corporate valuations on our M&A work for about 14 years before Colleen, who is going to heaven for this. Colleen let me quit my job and go back to school when I was 36 years old to get my PhD. So I found, much to my surprise, that when you have a terminal degree, when you have a PhD, that really, the courts look favorably upon that. So I spent one more summer in school and got my CVA, my Certified Valuation Analyst degree, designation. Pardon me, it's not a degree. It's a designation. And for the last 7 years, I've been very happily working at St. Joseph's University in Philadelphia. I'm a professor of strategic management. My research focuses on technology and innovation management, as does a lot of my consulting, but I also do lots of business valuation work on the side. Bobby is also at St. Joe's University as a freshman, but I promise I'm doing the best I can to stay out of his road, because at my age I realize what a liability I am to him on campus. So thanks for indulging me on that. Let me tell you a little bit about what we're going to try to accomplish in the next hour. I can't go into a lot of detail in an hour, but I think what we can do is understand the basics of how private companies are valued. There's three fundamental approaches to valuing private businesses. The first is what we call asset-based, and there are specific situations, which we'll discuss briefly today, where really a company's value is essentially based on the assets which the company holds. And we'll talk about how to value a company simply based on the assets that the corporation holds. There's an income-based approach, and this is probably the most frequently used. I use it in every time I do evaluation because most companies really don't have assets that produce their value. I'm assuming that right now I'm speaking to several attorneys out there. So if we were to look at a law firm, there really aren't a lot of assets on the balance sheet of a law firm that are indicative of the value that the law firm possesses. File cabinets and office space are great and you need them, but the real value that resides in a law firm is based on the credentials, the experience, the expertise, and the reputations of legal counsel and their staff. That's not on the balance sheet, but it is reflected in their collective ability to generate profit or income in the future. So there's some very strong empirical methods that we can use to estimate the value of a company today, based on the value of based on the profits that we can reasonably expect them to generate in the future. And then lastly, the most intuitive way to value a company is what we call the market-based approach. And it's a lot like getting the value of your home when you decide to sell it or when you decide to buy one. And there we're looking at comparables. Sometimes, not always, but sometimes we're fortunate to be able to look at a company and observe similar companies of comparable size and comparable lines of business that have been bought or sold in the relevant past that we can use as a basis to say, well, this company looks an awful lot like these companies, and we know what they sold for, so we can make estimates of what this company would sell for in a similar market. So my objective is to get you comfortable with each of these approaches, and if we have time within the hour to go over a couple of important technical aspects, and those are relative to discounts and premiums. Before we do that, some background, and I'm glad to hear from Emily that each of the folks on this call will have these slides, because here's some good reference material for you. And the reason I'd like to give you the reference material is you'll be talking to your clients and you'll be needing to make a determination as to whether or not a formal business valuation is ever required. So here are the lion's share of the reasons that professional valuations are done. Obviously, for mergers and acquisitions or for sales and divestitures, the decision maker wants a professional opinion as to what's the value of a company that we're contemplating buying or merging with, or what's the value of this division within our corporation that we're considering selling. The most common one is the one that's got the exclamation point behind it. In terms of my own business, estate-based valuations are often the most important, and that's when someone is bequeathing equity in a company, a privately held company, to someone as part of an inheritance. And for tax purposes, the value of that equity needs to be estimated so that that estate can be adequately settled. Buy-sell agreements are often one of my favorite ones to explain to clients that are starting their own businesses. And what I explain to those clients is when two partners are forming a business, they're high, they're excited, they think they're going to work together forever. And it's important, although it scares them at the time, it's important for them to contemplate now that they may not like each other forever and they may not care to work together forever. And so that savvy partners, when they form their business, develop a buy-sell agreement up front. And in that agreement, they agree up front on the principles that will be used when one or both partners want out. How will one partner purchase the equity or ownership of the other partner at a reasonable price? And that's easy for me because the buy-sell agreement will often tell me here's the process by which the partners agreed to purchase one or the other out, and I simply conduct those calculations. Bankruptcy or loan applications also require valuations, as you might intuitively expect. And then lastly, there's just one little technical thing that I want to throw out there, and that is purchase price allocations. And what that means is oftentimes a company acquires another company, and when they do, the acquiring company's balance sheet must be restated. It must be restated in order to capture these new assets and liabilities and intangibles that they're bringing into their company from the acquired company. And that can get tricky, and often a valuation person such as myself is involved in valuing each line item of the income statement of the acquired company so that that can be consolidated onto the acquired company's books. So a little bit more background before we get going. And that is that before we can conduct any valuation, we need to understand the dimensions by which value can be defined. And speaking with your clients, you'll develop this understanding before you would involve someone like me. And those dimensions are the standards of value, the premise of value, or the classifications of value. Standards of value can be either fair market value, fair value, or strategic value. And the one that most of us think of intuitively is fair market value. I'm going to leave with you the formal definitions of each of these. They're on the slides that follow. So forgive me if I don't quote them verbatim. But fair market value is what most of us think of. It's a reasonable buyer and a reasonable seller, both reasonably informed about the value of this transaction, where neither has a compulsion to buy or sell. It's the value at which, the price at which those assets would exchange hands in a fair market. Fair value is a kind of a technical concept that was established by the courts in the past. And that regards when there's either a wrongful termination lawsuit or a dissenting shareholder action. And the dispute occurred in the past, say June of 2013. The courts don't want to hear about the value of the company today. The court wants to go back in time and look at what was the value of the company when this dispute occurred. Because, and this is just me speaking, it seems to me that the courts got really sick of hearing, well, the company's worth nothing today, so this lawsuit is meritless. Because the defendant have been known to kind of run down the value of the company so that the plaintiff can't sue for any value. So the courts have said, enough of that. I want to know what the value of that company was on the day that this incident occurred, and let's look at that without, and this might make sense later, without any discounts being applied. In other words, what's it really worth on the books without considering marketability discounts, which we'll speak about a little bit later. Strategic value makes sense if we stop and think about it. And strategic value is related to why InBev, Anheuser-Busch InBev, the company that owns Budweiser beer, which is now no longer American. InBev, as many of you may be hearing on the radio, is considering purchasing SAB Miller, which if you're a beer drinker about my age, it's just amazing to think that Bud and Miller may soon be made in the same company. That's like the Cowboys, Philadelphia Eagles, and the Dallas Cowboys becoming one club. It just blows my mind. But InBev is considering purchasing Miller for what many analysts are saying looks like way too much money. If you look at the intrinsic value of Miller, why would Budweiser pay so much for Miller? Well, it's because beauty or value is in the eyes of the beholder. And Budweiser, Anheuser-Busch, obviously thinks they can do wonderful things if they could just bring Miller into their portfolio. So strategic value is the value that an acquirer places on a target that no one else would place on that value because it's particularly valuable to that acquirer. Then there's a premise of value, and that's for what purposes what's going to happen to this company after the acquisition is done. And this is often a basic agreement, a business agreement between the parties. Let's just value this at book value. That's frankly a no-brainer for me. Let's just look at the value of the company as it's recorded on its accounting statements. Very, very rare, but it can happen. The most common one is a going concern value, and that's that the parties agree that after the acquisition, this company is going to continue to be operated in its current state or something reasonable to that. There's liquidation value, and in that I'd be asked to find out what would this company be worth if we sold everything off piecemeal at the best possible market prices, sell it off piecemeal, liquidate the company. What would that stack of cash look like if we were to liquidate everything? And then sometimes you're asked to estimate the replacement value. What would it cost? What would the value be if we were to build this company from scratch and essentially replace it with a brand new company? And then the classifications of value are either tax or non-tax. The most common purpose of a tax-based valuation is estate planning, and M&A, mergers and acquisitions, is probably the most common example of a non-tax valuation. So in my experience, the most, but not all, valuations are for fair market value. What would it really, really sell for today as a going concern for non-tax purposes? So that would be an example of the three things we need to know. Here's the definitions, because I know I'm speaking quickly. So here are the definitions that we may need to keep in mind after this presentation. So I'm just going to show them to you for a second. When I teach strategy at St. Joe's, my favorite example of strategic value was eBay's purchase of a company called BillPoint in 1999 that was just hammered by the press as to what is eBay thinking that they would purchase an online billing company like this. Well, BillPoint was the beginning of PayPal, which anybody who uses eBay, I buy all my fishing equipment used on eBay so that my wife doesn't kill me. And anybody who uses eBay realizes that the intrinsic value of that service is your ability to consummate your transactions online. And so eBay needed an online real-time billing system that nobody else needed as much as they did. So they saw strategic value in BillPoint and made the acquisition at a very, very high price. And here's our premises of value, as we discussed earlier. Classification. Oh, I clicked through a little too fast. Here are the reasons, the examples of when we will do a tax valuation versus a non-tax valuation. So there's our definitions. Here is a slide that I'd like to leave you with as attorneys who consult with your clients in terms of, okay, we need a valuation. What type of valuation do we need? What's the standard of value? Usually fair market value, but not always. What's the premise of value? Are we going to assume that this company continues as a going concern? Is it a tax valuation? In other words, how are we going to use this valuation? Is it going to be to drive a deal, or is it going to be in compliance with tax regulations? Is this for a controlling interest of the company? I really hope we have time over this hour to talk about control premiums. But the price of a company is very, very different if you're entering as a passive investor, say taking a 5% equity in a company where 95% of the company is owned by a controlling family. Well, there you're just along for the ride, and you may enjoy some sort of appreciation in the value of that investment, but you can't tell that company what to do. You know, I still own shares of AT&T, and as best as I can tell, I'm not allowed to go ring the chairman's doorbell and tell him or her what needs to be done with that company because I do not have control privileges. So buying enough equity to take control of a company comes at a significantly higher price. Do we need to know if they're buying control? We also want to know how marketable is this investment. And that's essentially how easy is it going to be to sell this equity someday? I tell my students, think about trying to sell a cathedral from the 1850s. It might be beautiful, and it certainly has value, but it needs to be polished up. We need to do all sorts of repairs before it's marketable. There's probably 3 people in the whole world who might want a cathedral, so we have to publicize this and then find one of these people. And then guess what? They know that there's not many other buyers out there, so they're going to negotiate for a really sweet deal. So there's many considerations as to, are we selling a company that's easy to transact, or is this an unmarketable company, in which case, even though it looks like it's worth a fortune, like a cathedral looks like it's worth a fortune when you stand there and admire it, when it comes to actually selling it, it's really not worth as much because it's very difficult to sell. And then, oh, by the way, what's the scope of the valuation? Oftentimes I've done a great deal of work only to find out that I was not aware of the fact that there was land adjacent to this private business that's not going along with the sale. So it's important to make sure that, and owners may not, the owners who are thinking of selling or the acquirers who are thinking of buying may not have thought this through yet. So they need our encouragement to think about what's in and what's out. So there's another thing that we should think about here, and that is to keep in mind that purchasing equity in a company, in other words, buying the ownership of a company, is an investment. And it's subject to the 4 principles that any equity investment is subject to. The first is anybody who's going to buy a share of stock on the stock exchange today has alternatives. So this gets relevant when we start arguing some subtle points, probably not today, but in the future. So we have to keep in mind that any investor can walk away because they have alternatives. They're not forced to proceed with any investment. We also observe the principle of substitution, and this is based on the market-based valuation approach, which is we can look at the value of comparable assets or comparable businesses to estimate the value of this one. That's a very important precedent that needs to be considered. We have to keep in mind that investment value is often based on projected future returns, which can be subject to intense debate, as you might imagine. And then lastly, each investor requires an individual rate of return. And the biggest thing to consider here is how risky is this investment. If this is a startup in a fledgling industry by two kids who've never done anything like this before, we must keep in mind that the investor in that company is going to require a much higher rate of return. And that translates into a much lower purchase price. Why? Because these kids are a risky investment. And in order to entice an investor to come in, we need to promise them higher rates of return. Okay, I think we're allowed to get started. Yeah, let's start talking a little bit about the major approaches here. The first thing that any business valuation analyst does is look at the target company, the subject company's financials. Oh, I just jumped to the wrong slide. So what I'll do is I'll take a company and I'll do what I call common sizing their financials. And that means looking at every expense line item as a percentage of revenue. So I can say, oh, salaries are 15% of revenue. Depreciation is 8% of revenue. Why? Because then I can compare it to any other company that's got a slightly different size. Because once I convert everybody's financial statements into percents of revenue, I can say, hey, this company spends a lot more of its sales on salaries than this company does. What's going on there? The other thing that's obviously important is trend analysis. Is this a company that's shrinking, dying, or growing tremendously, or has it been stable for a long, long time? Each of those have tremendous ramifications to the value that we'll assign to it. I'll look at the financial ratios of a company, and I'll give you a cheat sheet on this in a second. But, we finance geeks have a broader way of ratios that we can calculate of a company that gives us quick and dirty insights as to the strengths, weaknesses, and distinctive competencies that a company owns. And then, which I've been alluding to for the last minute or so, we'll also do comparative analysis. I'd like to find other companies that are similar to the focal company and look at that focal company in comparison to other companies. Why? Because I'm looking for things that are unusual, because they'll help me understand the specifics of what's going on in this company. For example, when I look at the financial ratios of a company, which we call LAPS, LLAPS, we look at the liquidity of a company. Private firms are often holding way, way, way too much cash, much more cash than a publicly held company would. Why? Because they're not subject to public scrutiny. So they hold too much cash. And so the first thing I would do to a company is say, look, you have $2 million of cash on your balance sheet. Take that cash and put it in your bank account before you sell it. Why would you send this cash along with the company? Because it's of no intrinsic value. What are you going to buy $1 for? You're going to buy $1 for $1. So I will advise the seller, you've got way too much cash on your balance sheet. Remove this much because it's clearly excess. I'll look at a company's leverage. The company might be doing well, but if they're like a newlywed couple that has a gigantic house, and you worry about those kids, whether or not they can continue to make those mortgage payments if one of them loses their job or gets sick. So we look at a company's leverage. Do they have the ability to easily cover those interest payments even when the going gets tough? We look at their activity, which is a lousy word. It really should say efficiency. And in Tim Swift language, that is, can a company operate with less stuff than its competitors? Or do they use too much stuff to get their jobs done? We'll talk about that hopefully in a little bit. Profitability. Can they mark up their costs adequately in order to generate enough gross profit to pay their bills and to pay their salespeople? And then lastly, I like to look at how well they've taken care of their existing owners. Have their existing owners enjoyed any appreciation in value? All of those things will help me to understand, hey, here's a company that's got a tremendous competitive advantage or big problems. which will impact my ultimate valuation of the company. So here's an example. Oh, pardon me. No, I'm not looking at examples yet. Where am I going to get my benchmarks? Well, I subscribe to proprietary databases that give me financial statements for privately held firms. I can certainly go into CompuStat, to which I have access as a professor at St. Joe's, but CompuStat only holds publicly traded companies. And as many of you know, a publicly traded company is a considerably different animal than a privately held company because of the scrutiny to which they are held by the external investment community as well as the Securities and Exchange Commission. So sometimes I can get comparables from some of these databases. And when I say a comparable, I want a company that's about the same size, has been competing in about the same market over time, has a similar competitive position, similar lines of business, similar debt load. Keep your eye on the word competitive position because that becomes important in a minute in terms of what sorts of insights we can generate from a company. Oh, yeah, and there's a Robert Morris Associates database that has great benchmarks by industry. So here's an example of this, one of the insights that I always love to do. I don't always hit gold when I do this, but when I do, it's very insightful. So here's an example, quick and dirty. Almost every investor looks at return on invested capital to see how well their company is doing. And return on invested capital is simply net profits, how much are we making, divided by invested capital, which is how much stuff have we given these folks to work with. Well, somebody who was good at algebra and had a lot of time on their hands found out a long time ago that that ratio can be decomposed. Notice that revenues cancel for anybody that was good at high school algebra. And we find out that return on invested capital is a function of how profitable the company is, its return on sales, times how efficiently it runs. Can they get their job done with less stuff? So who cares? Well, we do a quick and dirty comparison of two well-known retailers, and we begin to see their relative strengths and weaknesses. On the left, we look at Wal-Mart's return on invested capital compared to Target's. And no one on this call is surprised to hear that Wal-Mart outperforms Target by almost 6 points. But we might be surprised to realize that Target's actually more profitable. And in fact, if we go all the way up to the top right, Target generates almost 10 cents more profit for gross profit. And what's gross profit? That's how much profit they make when a good goes through their cash register. So when merchandise goes through their cash register, Target's keeping 10 cents more on the dollar than Walmart. Target sells nicer stuff. They're what we call a differentiator. They're actually selling nicer stuff than Target. And guess what? Folks like you and me, are prepared to pay more for that quality. The rest of the story is about Walmart's cost advantage. Salaries, general and administrative divided by sales. SG&A divided by sales. We see that Walmart invests about 6% of their sales less on SG&A. They run a tight ship. Capital turnover is the great story here. And here we see that Walmart is almost 2 times as efficient as Target. They use about half as much stuff as Target does to get their job done. Look at PP&E divided by sales. That's property, plant, and equipment divided by sales. We see that Walmart has a 12-point advantage over Target. Their stores are incredibly well designed. Stand in sporting goods at a Walmart and walk to auto parts, and you will see impulse items that are most likely to catch a man's attention because auto parts and sporting goods are guy departments. There are similar cross-sections of that store that are more likely to appeal to children or women of various ages. And I assure you that your neighborhood Walmart has been designed like a grid to make sure that every square inch of that store is ideally designed to get the right people looking at the right stuff. And sure enough, Walmart gets a lot more sales per square foot of their store than Target does. The real magic is in how well Walmart manages their inventory. You've heard about this probably several times in your career, but the number is absolutely astounding. Walmart's about 7 times more efficient in how well they sell their inventory. There's examples that really still to this day impress me, but in the interest of time, I'm going to simply note that Wal-Mart can sell everything in their store in about a week. So Wal-Mart turns over their sales, their inventory in their store about once a week. But Wal-Mart doesn't have to pay their suppliers for about between 60 and 90 days. So if you think about it, Wal-Mart gets a delivery of Campbell's soup from Campbell's. They sell that whole delivery in about a week, but they don't have to pay that bill for about 60 or 90 days. So Campbell's, on an ongoing basis, is giving Wal-Mart a 53-day interest-free loan on the soup that they're selling. And that sort of logistical expertise is the essence of their core competency. So I do these sorts of things when I look at a company to start to understand how are they competing and how and where do they derive their value. So I know I'm supposed to stop here and see if there are any questions. Emily, do you have any questions that I need to address from the folks?
First, could all the attendees please type the passcode into the Q&A? Okay, and our first question is there more than one standard of value used in business valuation? No,
those are the standards of values that are commonly used. I've never seen an exception to that, and I've never seen it on the books in any state laws or anything like that. No exceptions.
Okay, and what is the difference between valuation and appraisal?
Appraisal is often used when we just talk about real estate. Like, for example, if I'm looking at a real estate investment company, I'm the valuation guy, but guess what? I turn to a real estate appraiser who will appraise the value of the assets. It's the distinction is loosely held, and it's not always applied, but an appraiser is generally looking at the market value of assets, physical assets, whereas a valuation person is looking at the value of equity.
Okay, and can a CPA appraise a business?
CPAs are often in this line of business, yes, because they have a very good understanding of breaking apart and tearing apart balance sheets and income statements. Yeah, I have found, and I know of good CPAs who do good valuation work. I decided to get into this work because I found that the courts are more likely to admit me as an expert witness because I have a terminal degree. And so if you need somebody who's going to pass muster in the courts, I find most of us have terminal degrees, but not always. And as many of the folks on the call could imagine, you know, a man or woman with 25 years as a CPA with a tremendous track record is very likely to be approved by the courts.
Okay, and when should someone have his or her business appraised?
Well, heck, I've read articles from people in my line of business that talk about it like a dental checkup or cleaning. You know, every year. I think those folks are trying to drum up business. In general, it's during a significant life event. There are some folks, I've yet to deal with them directly, but I am aware of some folks that are just merely curious. You know, mom and dad are thinking about turning over the business to their kids, or mom and dad are thinking about granting the kids, you know, a minority position of equity. And it's maybe 3 or 4 years out, but they're curious as to how this might impact the kids' ability to live comfortably. So they might get it done out of curiosity. But really, valuations are done before preceding significant life events, such as the ones that we outlined at the beginning of this presentation.
Okay, the next question is, in valuing a business, how do you factor in that there may be employee benefits such as health insurance, premium contributions, pensions, or stock options that may not be secured? For example, they can be ended?
For example, they could be ended?
Yes.
Was that the end of the question, Emily?
Yes.
Yeah, so that's often a valuation issue when we get into ESOPs, employee stock ownership plans. And so really, I rely on the assumptions of the current owner. And this is I'm glad we got this question because this is a very important point for attorneys as well as the valuation expert to understand. And that is that when it comes to the assumptions as to how the business will be run, We don't run that business. When I say we, I mean legal counsel and me as a valuation analyst. We don't run that business. So we will ask our clients, the principals of that business, whether or not they would intend to continue to run those benefits. But then we would also have to look at precedents. In other words, the existing owner has always offered these benefits, but will the future owner offer these benefits? Then I would probably be doing a little bit of research in my comparables database, pointing out to the owner that, hey, you know what? You've been great to your employees by offering these benefits, but once there's a change in control in this company, it's highly likely that the future owner will discontinue these benefits. So I would be turning this back to the owner, saying, I think that your future income projections, since it's going to be a change of control, in other words, since we're allowing a control premium to go with this, do you think it's reasonable, sir or madam, that we project future incomes without these benefits in there? But I would ultimately be leaving that decision. I would offer my opinion, and if I was ever, under cross, I might say that, yeah, it's entirely appropriate that the future owner could terminate these benefits, but we left them in for now, or we terminated them in our future valuations because it's generally accepted practice in this industry that such benefits are not offered.
Okay, those are all the questions we have for now, so please continue with the presentation.
Great. Thanks, Emily. Where are we here? Okay, so I'm looking at all these ratios, and I'm looking at common size income statements. Why? Why do I want to get down and dirty into financial statements before I do anything else? Well, because, similar to the question that we just received, companies are often family businesses. And you know what? You're allowed to run your family business pretty much however you see fit, as long as you're not dodging taxes. So we do see, for example, that family businesses really drive expenses up as high as they possibly can in order to reduce income taxes. I can say, with a straight face and a clear conscience, that since I run my consulting business out of my home, I take every opportunity to expense the home office portion of my house into my financial statements at the end of the year for my tax return. That's for tax purposes, right? We could also find that the family has been expensing things that were probably too aggressive, and that on a fair market basis, we should remove some of those expenses. My favorite example of that is excessive compensation or rents. So, for example, it's husband and wife. It's the wife's business, and the husband's on the payroll as general manager. And we find out that, husband is a retired truck driver, and he's never run a business in his life, but yet he's a general manager on the payroll for $75,000 a year. She's allowed to pay him whatever the heck she wants. And he's her husband, so, hey. But guess what? There isn't anybody out there who's going to do what he does for $75,000 a year, especially when you find out that he's in the office about 2 days a week. So I would certainly adjust their income statement for those sorts of excess compensation. Also, it's not uncommon for a family business to be renting facilities from another related family business at above market rents or below market rents. So if I am selling a controlling interest, in other words, I'm going to let somebody take over this company, I need to take all that weird family stuff out of this business, which relates to the gentleman or lady's question a minute ago in terms of options, employee benefits, et cetera. But if I'm selling a non-controlling stake and mom and dad are going to continue to run this business as they see fit, then I leave them in. But I certainly want to consider those things to make sure that I have a normalized financial statement before I proceed. I have to get all the weird family stuff out. So here's an example of where I start. So, all right, I'm ready to do my valuation. I need to know if it's for control, as I mentioned. I need to know the purpose in terms of whether it's going to be for tax or non-tax. I need to understand how I'm going to do it. And that's ultimately at my discretion, But for example, if I have a strong set of evidence that companies in this industry generally sell as a multiple of earnings. In other words, a company makes $100 a year, and I find out as a rule of thumb that almost everybody in this industry sells at 3 times earnings, so therefore the value of this company is $300, then I better make sure that I've got a really good, clean, normalized number for net income. I have to make sure, so some technical points here, but I want to make sure that if I'm using earnings instead of net cash flow, I have to make sure that there's a reasonable proxies. Am I valuing just the equity? That's the ownership portion of the company. Or am I valuing all invested capital? That's
Tim, are you still there? We seem to have momentarily lost our speaker, but we will get him back on and we'll continue the presentation. Thank you.
Oh, it's Tim. Can you guys hear me? My stupid cordless phone died.
Oh, no, we can hear you now.
Oh, boy. I'm sorry about that. Sorry about that. I'm back. Nobody killed me. So I think I heard my phone go dead when I was talking about whether or not we're valuing equity or all invested capital here on slide 26. Equity is we're just valuing the stock, the ownership in the company. But sometimes companies sell for both. The debt goes with it. In other words, I'm going to sell the whole company, all the invested capital in there, debt plus equity. So that's an important consideration. So now we can talk about some of the specific ways that companies are valued. There's an asset-based approach. You know when this works? When we're looking at companies that manage real estate. In fact, we just did one, and it was a real estate investment holding company. They've got a few industrial parks over in South Jersey. They don't provide any services. They don't provide any revenue-generating services, so they don't do security or lawn care. It's just a corporation that has inside of it a bunch of business parks, and people are renting space in there and doing their own services. So I got out of the way in a hurry because really we needed real estate appraisals of each of the pieces of real estate in there. So to jog your memory, asset-based approaches are generally appropriate when a company doesn't provide any services, but the corporation, the legal entity, possesses simply assets. There's also the income approach, as we discussed. A law firm would probably be valued based on its income-generating potential. There's 2 different ways to do that. And then there's the market approach, and that's like real estate, right? We know of comparables, so let's look at other companies that have sold in similar circumstances and see what they're worth. Yep, and if we're going to do an asset-based approach, we always have to make sure we understand whether we're replacing, selling, or going to continue to operate that company. So, what's an income-based approach? We can either do a capitalization of earnings or cash flow, or we can do a discounted earnings or cash flow model. I'm looking at our time that's left, so I'm going to keep this at a high level to make sure that we cover these 3 approaches and still have time for questions. I can look at a company's current earnings capacity, and I can divide that by the investor's required rate of return. And that equates the value that that investor will pay for that company. So in the example on the top of this page, I have a company that's generating $591,000 a year. The investor requires a 21.32% rate of return. For finance reasons I wish I had time to explain, but I can't within an hour, that company, if it continues to generate $591,000 a year, is worth $2.77 million to an investor who has that required rate of return. Then we're going to throw in other assets. Let's say there's adjacent land, $771,000. Got an appraisal from a realtor? Great. That company's worth $3.54 million based on its current earnings capacity, assuming that that earnings capacity continues on forever. That is often not, let me see if I can find a better picture. That is often not a good assumption. Let me see. There we go. It's often not a good assumption to assume that a company's earnings is going to continue to be the same, because companies grow and shrink and they change markets and they acquire companies. So if we cannot reasonably assume that those cash flows are just going to continue as is forever, we need to make a discrete forecast of how those cash flows will change into the future, and then we can adjust all those future cash flows back to what they're worth today. And that's what we call the time value of money. Anyone on this call realizes that they're much more interested in getting $1 today than they are receiving $1 a year from now. So we need to do some algebra to say, well, this company is going to generate a lot of money, but it's all in the future. So let's adjust the future value of money to what it would be worth today. And that's called a discounted cash flow method. I am going to, unfortunately, I want to make sure we get to one part here that's important. So I'm going to move forward a bit and look at this slide. That one right there, that was a good one. That's a great slide. You might say to me, well, wait a minute, how'd you come up with that cost of that required return there, that 21.32%? How do you know what a reasonable investor requires as his or her rate of return? Because we all want like 1,000,000% rate of return. Well, we have an empirical method, and the most commonly used one is called the Ibbotson build-up method. And here's the scary-looking formula, but we all use it. All the courts accept this. And K of E is the cost, the rate of return that investor requires. And it's built up from a risk-free rate of return. That's interest we can get anywhere on a United States Treasury bill. An incremental risk of investing in equity. Anybody who's invested in stocks the last couple of weeks, last couple of months, thanks to Greece and China, we know that there's no guaranteed return in equities. So if you're investing in equity, you get a higher rate of return. Some industries are more risky than other industries. So we may have to assign another premium because you're going into a scary industry. Very small companies are risky because they can get wiped out by a big mistake. And then there's company-specific risk, which is the management's not very deep. You know, Mrs. Smith does everything. That's the biggest company-specific risk I see, is lack of depth of management. You know, Mrs. Smith does everything. And so if she was to ever get sick, God forbid, that company's not worth anything because the value is essentially Mrs. Smith. So we build up these rates and come up with something like this. Here's an example of an Ibbotson build-up method. The risk-free rate of bonds at the time I grabbed this snapshot was 5%. And when we add on these objective, I'm not doing psychoanalysis with an investor. I'm objectively looking at the risk that he or she is encountering and the premiums that are out there in the market. And I end up with a build-up rate to going from 5% to a rate of return of about 21.3%. I think we're going to wrap up in just a minute. So let me, until Emily tells me to shut up, let me just cover real quickly an asset-based approach, which is this slide. I'm going to go on to a company's balance sheet. And at your leisure, you can look at the notes on that balance sheet, and you can see the adjustments that I've done to a company's balance sheet. I've removed excess cash, as I mentioned before. Hey, guys, there's no reason you need to send this cash to the buyer. Keep it for yourself. They had a quirky inventory method. They used last in, first out, which accountants know all about. should be first in, first out. So I changed it from LIFO to FIFO. There were some assets in there in the property, plant, and equipment that are not coming with the business, so I need to take them out. And really, that's a pretty quick and dirty job for me to do. By the way, the land needs to be adjusted to market value. Or pardon me, the buildings need to be adjusted to market value. So a real estate appraiser needs to help me understand what's the true value of the buildings, not just the value of what's on the books, because that value was entered on the books back when it was acquired. I would make similar adjustments to the liabilities and equity, which is not as interesting, so I'm going to skip it. And then finally, as we wrap up, we've got the market-based approach. Market-based approach, everybody gets it, right? So the advantages are everybody understands it, and nobody's going to quibble with my forecast. How could you say that cash flow is going to grow at 15%, Swift? You're making that up. Well, if I can point to an actual sale that occurred, everybody settles down because I'm not using my own forecast. The problem is the following. Very hard to get a perfect comparable. And if you do, it's only one. So do we want to base our whole valuation in one other deal? What if that buyer was crazy? What if he went too low or too high? Well, often we don't understand the standard of value. Was there strategic value? Did some guy have to buy out his competitor so that he could have monopoly power within a small town market? So he paid way too much to purchase the other carpet store in town? We don't want to use that if it was purchased on strategic value. And oftentimes there's hidden elements in the deal, a non-compete agreement, or an agreement that I'll continue to work for you way below market for the next 3 years, or an earnout that I don't get paid until this company grows 15%. So comparables look fun and they look really easy, but if we don't understand exactly what's in those deals, they can be very, very misleading. And we basically do, and Emily, this will be the wrap-up for me. What we do, yeah, I know, great, wonderful. We just talked about that, fantastic. Here we go. This is what I wanted. Really, I wanted to just draw your attention as we wrap up to that last line here. So we know the earnings of a company that we want to buy. And we know the earnings of a bunch of other comparable companies. And we know the price of those comparable companies. Well, my algebra friends on the call will notice that earnings cancel. The earnings of the subject company cancels out with the earnings of the comparable company. And if we multiply the earnings of the subject company times the price divided by the earnings of all the other comparable sales, we will come up with the market price of the subject company. So, Emily, I think I was supposed to save some time for Q&A. Did we save enough time? I know I'm finishing up fairly quickly.
Yes, we do have enough time. So could all the attendees please type the passcode into the Q&A once again? And our first question is, how do you account for value of intangibles of a service firm like business goodwill? Great.
So first of all, if there's a company that's got services, we would not do an asset-based valuation, right? We would look at a forecast based on their income. And there's something called the excess earnings method or the treasury method. And believe it or not, it goes back to the days of prohibition when companies that were manufacturing liquor were being forced to shut down. And these companies protested that there was intangible value in their brand. And so what we do is we look at the value that's being generated out of income. We don't see the value on the balance sheet in assets, but there's value. Why? Because they're generating great income. And then we subtract off of that, essentially, the value of their intangible assets, and then we would enter onto the intangible assets line item on their balance sheet. We would include a value for intangibles. And what is it? It's this extra income that seems to be generated based on income that they generate outside of their productive assets. But there is a formal method to do that. excess earnings, or treasury method.
Okay, the next question is, if someone wants to buy part of an ongoing business, does both the buyer and the seller need a formal business valuation?
Well, no one needs a formal business valuation unless it's for tax purposes. I assume that the courts could order one, but this is almost always done to settle reasonable disputes. Sometimes there's a very clear understanding of what a company's worth. Buyer and seller agree strongly on it. Valuation isn't required. If both parties agree on what the value is and there's no problems, then a valuation isn't required. It's only when there's disagreement or disputes over the value. And I might be bragging here, but so far, when I have entered my valuation reports onto these issues, they've been accepted by the other side. So in my experience, if there's one good valuation report that's entered, and by the way, what's a good one? Where I am clearly not taking an advocacy position. And these reports must be written in a non-advocacy way. And if those reports are properly developed, then that could be the only valuation that's used to settle the case.
Okay, the next person says, I have a potential client asking me to value an intangible asset, specifically a database of resumes, and wants to sell it to another employment company. None of these formulas seem to work. Is this an exercise of imagining what a strategic buyer would pay?
So there's similar problems exist on patents, right? So I don't want to sell my company. I have a patent that makes really great hot cocoa. I have no idea why I came up with that. So how do we value that patent? And there are ways to value just a single intangible asset. And what we try to do, the two biggest ways is we look at has this existing owner been licensing it? In other words, has somebody been paying by the drink to use this resume database? If they have, we can value it because we can say, well, every time somebody uses this database, they pay $5, and you can use this you can sell this database 50 times a day. So 50 times a day times $5, there's your income stream. If they haven't been licensing it, if nobody's been using it by the drink, then we look at comparables, just like we do for a real business. We look at other services that, for example, say Monster, off the top of my head. We would look at what Monster charges to have a company go in and look at their database of resumes and see if we can derive a comparable value from there.
Okay, and how long does the business valuation process take, and what is the price range for the written report?
So I just finished one last week. It was I just feel so bad. It was a divorce that was sailing along perfectly. There was tons of agreement, and then the agreements quickly fell apart. And I was asked to pull it together in 2 weeks. I was able to work the weekend, got the job on Thursday, absolutely worked the weekends, and had it done the following Monday. And it was a fairly rigorously one. It was uncontested by the other side, thank God. So, and this is a big one. I'm saying this with italics and boldface here. Depending upon the availability of the right data. This guy who contacted me had everything laid out. He had it to me via email in 3 hours. And it was so well organized that I was able to buzz through it almost completely on my own. If the client is poorly organized, I've had ones where, tax returns haven't been filed in 5 years and nobody wants to identify the tax accountant because he was a bum. So if the documentation is poor, I couldn't put a number on it. If it's a straightforward valuation, I don't want to brag that I could turn them around again in 5 days, but I certainly know I could turn them around in a couple of weeks. The valuation that I just did that was so straightforward went for $6,000, and it was not disputed by the other side. They can start at $1,000. I have not billed this much, but I am well aware of valuations that got complex and required many, many, many revisions that went as high as $15,000. I've never heard of anyone. I've never charged that. I know people who have, and I would say that that's probably the ceiling these days, but I might be wrong.
Okay, this person had previously asked the question about employee benefits. And they're asking again, isn't valuation too speculative when the company offers employee benefits, which may be withdrawn in the future?
So if that was an absolute point of contention, that will the next owner continue to offer employee benefits, then one way to get the parties to consider this is to run a valuation under the assumption that the next owner continues to run benefits, offer benefits, and then under the assumption that the future owner does not offer benefits. And then we can value that assumption. I would prefer, and the courts would prefer, me to take an opinion, I underscore that, my opinion as to whether or not benefits are generally offered in that industry. And I'd have to do some digging, but I know where I'd go to find out whether or not it's reasonable to expect that employers within that industry offer benefits. And you say, well, how can you say that? Well, you know what? If you want to open a hamburger joint in my town and you're going to just assume that you're going to pay $6 an hour, you're not going to get any workers. So labor markets are efficient. In other words, there are set prices out there. And so we can easily establish, I believe, we can easily establish whether or not the going rates in any given market include benefits. If they do, it should be in. If not, it should be out. That would be my opinion, but I would, depending upon the advocacy positions of the attorneys, one guy would say I'm right and the other guy would say I'm wrong.
This is going to be our last question. So if the new owners will not have control or marketability of a business, how do you evaluate the discount for that?
Oh, so I just knocked off your questions picture. So if they do not have control, there's processes which I'd love to go through if we ever want to do another one of these seminars, because that's I think the most fun stuff. There's lots of studies out there in terms of how the value of a company changes once someone takes control of the company. So here's an intuitive example. A share of IBM is selling for $5 a share right now. Some investor comes in and buys control of IBM at $8 a share. Why would they ever pay $8 a share when I can buy a share for $5? Well, guess what? That was the control premium. The fact that this person wants control of IBM was worth $3 per share to that person. So there's lots and lots of databases out there where we can observe how much people pay to get control of a company, and we apply that reasonable investor standard to a company. There's also a court case, Mandelbaum, really intelligent judge who had enough of squabbling over lack of marketability discounts. And in the Mandelbaum case about 10 years ago, that court said all discounts for lack of marketability will consider these 8 points. And so far, that is holding a lot of water. And we all go through those 8 points to consider what the discount for lack of marketability will be. I wish I had time to show it to you, but it's a quite rigorous and quite logical process.
Okay, well, thank you so much for answering those questions.
Great. I appreciate everybody's time. I'm really sorry that I lost my mic.
That's okay. As long as you came back, that's fine. In addition to being your best source for testifying and consulting experts, TASA also offers e-discovery and forensic solutions, free interactive webinars, cybersecurity services, and day-in-the-life videos, as well as research reports on expert witnesses such as the Challenge History Report 2.0, the Professional Sanction Search, and the Expert Profile 360. I want to take this opportunity to thank everyone for attending, and most especially Tim Swift for his time and effort in creating this presentation. If you would like to speak with Mr. Swift, or if you would like to speak with a TASA representative regarding an expert witness for a case that you're working on, please contact TASA at 1-800-523-2319. Thank you all again for attending, and have a great day, everyone. This concludes our program for today.